Skinner from AFS. I appreciate you watching this short video. The banks have wrapped up their second quarter earnings calls, and we wanted to share with you a mid-year update focusing on commercial lending, but also weighing in on some of the top-of-mind issues the banks are facing heading into the second half of the year. Now, hopefully the second half won't be quite as volatile as the first half was, but the banks will still have a number of challenges that they're going to have to continue to navigate. Now, commercial loan growth, which of course is a primary driver of bank earnings, has been on a steady downward trajectory for most of the year. This has been equal parts a supply issue and a demand issue. Now, on the supply side, banks have been tightening their underwriting standards for several months now, which means they're becoming much more selective in terms of who they are willing to lend to. And then compounding matters, the industry experienced 3 of the largest bank failures in its history just a few months ago. And that started a crisis of confidence of sorts. And in response, the banks now are being more protective than ever of their balance sheets. They're raising capital in anticipation of regulatory capital requirements going up. And they're just taking on a much more risk-averse posture heading into the second half of the year, particularly with continued mixed signals coming from the economy in general. Now, on the demand side, the Fed raising rates over 500 basis points in relatively short order is going to have a negative effect on business demand for credit. That's what the rate hikes were intended to do, though, and it's definitely working. So this combination of events has resulted in a real pullback in commercial lending activity, as you can see on this chart. C&I growth has actually been negative 4 of the last 5 months, and commercial real estate growth has also finally started to slip. Again, we see the banks being incredibly selective right now in terms of customer selection and protecting their balance sheets. Now, another indicator we watch closely are the spreads the banks are able to obtain on the loans they're making. And after rising during the early part of the year, spreads over the last month have fallen across all deal sizes. Now, we attribute this in part to lower overall deal flow. So with softening demand and higher interest rates, overall deal flow is below normal. So you have no shortage of competition, of course, for the deals that are available, and that's going to put downward pressure on pricing. As you can see on this slide, there's a strong correlation between spread and the size of the deal. Generally, the larger the deal, the lower the spread, as those companies are often stronger financially and have better credit ratings. So the smaller businesses usually end up paying more for credit than the larger companies. So the banks have no shortage of challenges heading into the second half of the year, beginning with shrinking profit margins. Net interest margins have peaked for most banks, and now 2 things are happening. Banks are seeing a shift in funding composition with more reliance on more expensive sources of funding, such as CDs, brokered deposits in some cases, and borrowed money. And their deposit betas are going up quickly. And what that means is that they're having to pass through a much higher percentage of the Fed's rate increases to their customer now than they were doing last year. And that is squeezing their margins. Banks also continue to set aside money for potential loan losses, not in huge amounts, but selectively for certain products like credit cards and commercial real estate mortgages on office buildings and certain healthcare facilities. The large banks in particular are taking steps in anticipation of having to hold more capital going forward. Just this week, in fact, the Fed released a set of proposed rules designed to strengthen capital requirements. And while some of those rules are part of the continuum, that is the Basel Accord, some of the changes are in response to recent bank failures and shortcomings in liquidity planning and risk management. So related to this, some of the regional banks, in fact, have publicly stated their intention to reconfigure their balance sheet, and in some cases even operate at a smaller size going forward. These are unusual steps, but are another way to conserve capital. So in summary, we are anticipating a continuation of the current trends we've outlined here, slower loan growth for the second half of the year, as well as an internal focus on expense management on the part of the banks. As always, thank you for your time. Have a good day, and give us a call or send us an email if you have any questions.